I think the risk to banks and also insurance companies and also pension funds, frankly, will come from...
You're watching Silver News Daily. Subscribe for more.
Silver has been playing second fiddle to gold for years now, but that's about to change in a way no one saw coming. Adrian, a leading expert in precious metals, believes silver is poised for a massive rally that could shock the entire market. What if I told you that this run could push silver to heights we haven't seen in over a decade? Stay with me as we break down why this moment in silver could be your chance to catch a once-in-a-lifetime investment opportunity.
Well, when you say there's been signs that the stock market is overvalued, I think we've had signs the stock market is overvalued for a while. But of course, things can remain overvalued for a long time, just as they can remain undervalued for a long time. What we've been seeing in the last couple of months, when we had the stock market drop last month, you know, some of the big tech leaders led on the downside. Now they've recovered. But interestingly, if you look at, we're in earnings season now, NVIDIA reported last night. If you look at five out of those seven, the Magnificent Seven, 5 out of those 7 were higher before their earnings and after their earnings, NVIDIA being a prime example. And I think that's a reflection of the fact that maybe people are beginning to realize that some of these stocks are a little overstretched, shall we say. When you drop on earnings. And I mean, if you're a NVIDIA fan, NVIDIA's earnings weren't that bad, right? It's just that it really brings home to you just how overvalued these stocks are. So I suspect we're going to start to see rotation. Again, when interest rates start to come down, typically these long duration companies that don't have earnings or much in the way of earnings in the short term, they will tend to fall faster than, let's say, the value stocks, but are more reasonably valued on a valuation basis. So I think we're going to start to see rotation, out of those high flyers, out of the stocks that have led the market for the last few years and into the ones that have lagged, like small cap stocks. We'd expect the Russell stocks to perform better, the value stocks, the good dividend payers, obviously a company that can pay a good dividend and the dividend is sustainable. If other things being equal, if interest rates decline, then that stock becomes more attractive because the dividend becomes more attractive. And I think we'll also see some rotation into commodity stock. Things have been left behind, like commodity stocks, oil stocks, and hopefully gold stocks.
For years, the metals market has been a wild ride, defying predictions, breaking norms, and leaving investors scratching their heads. Take 2022, for example. Inflation was through the roof, and yet metals, which have soared, did the opposite. Even more surprising, silver and gold rallied right alongside a strengthening U.S. dollar, something that typically never happens. It's these unexpected twists that make the metals market so fascinating, but also so difficult to predict. Yet through all the noise, one voice has consistently cut through. Adrian, he's been watching the metals market closely, warning us that silver's time was coming. And it seems he may have been right all along.
We've had in a lot of things, but particularly, say, the employment picture. We had that massive new jobs revision number last week by the Bureau of Labor Statistics, where they said they had overestimated new jobs by 818,000. I mean, that's massive. So that kind of puts a dent into the strong labor narrative. And the other thing, frankly, is that you look at this year, pretty much all of the jobs growth this year, net jobs growth, has been either part-time jobs or government jobs. And that's not a healthy economy. So, we could go through all different sectors of the economy, but basically I think the economy is already weaker than it appears, and the employment in particular, and that's, I think, the employment picture deteriorating is why the Fed decided to, why it appears the Fed will act next month. So that's going to have an impact, obviously. If the Fed starts cutting rates, that's going to have an impact on the economy, but also on all markets. Typically we would expect that when the Fed starts cutting rates, then there will be a period, whatever that period is, a year, 2 years, of rate declines, whether it's every meeting or every second meeting or whatever. But the trend will be to cut. They don't cut, then raise, and cut, then raise. You've got to start really cutting rates meaningfully for it to have an impact on companies and households whose interest rate charges have gone up so much. So typically, when the Fed starts cutting rates like that, it's a sign that we are in or heading towards a recession. And the interesting thing is that is actually a very, very positive environment for gold and gold stocks. Not the recession itself.
Adrian Day has a track record that's hard to ignore. This isn't someone who's just hopping on the silver bandwagon now that the momentum is building. He's been spot on with his calls for years. In fact, back in 2011, when gold hit its peak, Day's analysis was within just $6 of the actual top. And it wasn't just gold. He predicted the 2015 bottom in silver too, telling his followers to get back into the market just before the precious metals began their next big rally. Fast forward to today, and once again, Day is sounding the alarm. But this time, it's all about silver. According to him, we're about to see one of the most significant runs in the market's history, and it's going to catch many people by surprise.
But the Fed's reaction to recession is very, very positive for gold and gold stocks. Interestingly, it's a lot less positive if you look at history, it's a lot less positive for stock markets. And it makes sense because when the Fed starts cutting rates, it's a sign that the economy is slowing. If the economy is slowing, then even if companies are helped on the interest rate, on the debt side of the equation, they're finding demand for their goods and services goes down. And so we're going to start to see earnings, decline, and that typically is bad for stocks. So I think the period we're heading into will be positive for gold and gold stocks, negative or neutral at best for the equity market. And when I say neutral, I mean it'll be very negative for some stocks, like the long duration unicorn stocks. They will tend to be hurt, and we'll get rotation into more value-oriented stocks, more real stocks, stocks with good dividends, and hopefully into commodity stocks.
No, it typically works that way, right? When we see a rate cut that it's good for gold and commodities. Is that, as you've seen, different rate cuts, is that typically what happens?
No, absolutely it is. Now, of course, the big exception was 1980, but that came after Volcker had absolutely killed inflation. But yeah, typically, if you look at the last 7 rate cycles, when the Fed starts to cut, then that is very, very positive for gold. Other commodities can act differently. If we're in a stagflationary period where we have inflation and a weaker economy, a soft economy, then typically commodities do well across the spectrum. And oil is often actually the leader, outperforming even gold. If you're in a more deflationary environment, then that tends to be much more positive for monetary metals, gold and silver, but much less positive for commodities. So I think an awful lot depends on just how bad the economy gets. Soft growth or zero growth plus inflation for commodities will do very.
Now, let's dive into the details of why Adrian Day is so bullish on silver. It all comes down to the technical setup. Silver has been hovering around a crucial support zone between $28 and $29 per ounce. According to Day, as long as this level holds, we're looking at a potentially explosive move upward. The next key level to watch is $32. If silver breaks through that, we could see a fast rally pushing prices to between $36.50 and $40 per ounce. This setup has been building momentum for months, And if silver can push past that $32 mark, we might be in for a run like anything we've seen in recent years. But it gets even better. Dave believes this rally could happen quickly, making it one of the strongest moves in the precious metals market.
And yes, it already is changing very slowly. I mean, if you look on a 12-month basis, gold has outperformed. If you look on a 6-month basis, more or less the same. I'm just looking right now, and it shows gold up 22.3 and the XAU up 23.5. So basically the same. That's year to date. If you look at 6 months, then the stocks have well outperformed. If you look at 1 month, the stocks have outperformed. So I think and so is silver, by the way. So I think we're beginning to see that turn where the gold stocks and silver outperform physical gold, which is what we normally expect in a gold market. This gold market has been different, of course, because of the source of the demand and why people have been buying gold. So when central banks, as we know, have led the gold market over the last 12 months, 18 months, and central banks are buying physical gold. They're not buying Newmont or Barrick or, let alone junior exploration stocks. And so it makes sense when you think about who's been buying and why they've been buying, it makes sense that gold has gone up more than the stocks. But that is beginning to change. And I think this is a remarkable opportunity, to be honest with you, Elijah, because normally at the beginning of a gold bull market, and go back to 71, 76, 80, 2008, at the beginning of a gold move, the stocks tend to outperform at the beginning dramatically. Once gold bottoms and starts to move, the gold stocks outperform dramatically. So go back to 2000, for example. I think gold was up about 12% in the first 3 months, which isn't bad for an insurance asset. And the gold stocks were up over 50%. So that's the typical sort of, and we saw that in 2008 as well. So I think we have an unusual and very attractive opportunity now to still buy gold stocks before they have had the leverage to the gold price, and while they are still fundamentally inexpensive. And that is something, a lot of people, as Oscar Wilde once said, people know everything about price, but nothing about value. And you look at what the gold stocks have done in the last, 2 months, and you say, oh, I'm not going to chase these stocks. We forget that, first of all, the stocks, just in terms of price, are a lot lower than they were in 2022, let alone 2011 and 2012. But in terms of value, I've given this example before, but you look at Agnico Eagle, for example, which has had a very strong move this year on the back of some very strong quarterly reports. Agnico Eagle is selling at about 8 times cash flow. And if you look back at its history, it has rarely been meaningfully lower than that. So it is selling very, very close to its all-time low in terms of price to cash flow. Barrick, for example, on a price to net asset, same thing. It's within a couple of percent of its all-time low price to net asset. And when you've got gold making new highs, you expect multiple expansion. You expect the stocks to trade at higher multiples. So no, I think we have a very, very attractive opportunity right now.
One of the biggest questions people ask is, why has silver lagged behind gold for so long? To understand this, we need to look at the history between these two precious metals. Back in 2011, silver hit its peak in April, months before gold reached its high in September. While both metals usually move in tandem, silver often plays catch-up, and when it does, the move is dramatic. This lag isn't necessarily a sign of weakness. It's part of a cycle. Silver's volatility is what makes it such a unique investment. Adrian and other market experts point out that silver's price action often mirrors gold, but with even more intensity. When silver does decide to move, it can see exponential gains in a short period. Think back to the parabolic rise we saw in 2010-2011, when silver prices more than doubled in less than a year. Day believes we could be on the verge of another massive move like that. What's fueling this potential run? It's not just the technicals. Silver's unique role as both an industrial metal and a store of value means that it benefits from multiple market dynamics. With the growing demand for silver in tech industries, think electric vehicles and solar panels, combined with its appeal as a hedge against inflation, we have a perfect storm brewing. Adrian Day believes that the longer silver lags behind, the more explosive its rally will be once it catches up. And when it does, we'd see a parabolic rise that leaves even the most seasoned investors in awe.
Certainly have concerns about financial institutions, including banks. A lot of the regional banks, the smaller banks, a lot of insurance companies, pension funds, for example. They will, the banks will be helped by lower interest rates, right? Because it's so I mean, that is not more banking problems is not number one threat that I see if we move into a period of rates coming down. I think the risk to banks and also insurance companies and also pension funds, frankly, will come from commercial real estate, because we all know the commercial real estate market is not doing well. We've all heard the anecdotes about buildings that's, sold for $4 billion and 5 years ago, and then were sold, last week for $500 million. We've all heard stories about, new office blocks that have 20% occupancy, etc. But, there's an extend and pretend on valuations. So a bank does not want to foreclose. They certainly don't want to foreclose on a lot of properties. So long as they can keep those things on their books at the value marks that they have, they're happy to do that. There is a point, of course, when you can no longer pretend. When if the lender goes bankrupt, for example, you have to change your marks. If you're in a syndicate and everyone else in the syndicate is marking down, you have to mark down. If you have auditors come around and start saying, I'm not sure about these valuations, you have to change the valuations. And I think that's where we're going to see a big risk a big structural risk in the US economy. You look at, for example, banks and insurance companies. I mentioned syndicates. A lot of these big office buildings are syndicates, and sometimes they're international syndicates. You've had Japanese banks and Japanese.
Let's talk about a crucial factor that could light the fuse for silver's next big rally: the Federal Reserve. You see, interest rates and precious metals have a very intricate relationship. Normally, rising interest rates make metals like silver less attractive because they don't generate income. But with the U.S. economy showing signs of slowing down, especially with weak job growth, many analysts believe that the Fed is about to shift gears and cut interest rates. In fact, the CME FedWatch tool shows that markets are already pricing in a 25 basis point rate cut at the next Fed meeting. So why does this matter for silver? When interest rates fall, the opportunity cost of holding non-yielding assets like silver decreases, making it more attractive for investors. This is one reason why Adrian Day is so optimistic. The economic backdrop could soon become much more favorable for silver, especially if the Fed starts cutting rates. Historically, silver tends to rally when interest rates drop, and given the current market conditions, we could see a domino effect where lower rates ignite a powerful upward movement in silver prices. But here's the kicker. Silver doesn't need to wait for the full cycle of rate cuts to start its descent. Even the anticipation of a shift in Fed policy could be enough to trigger a strong move. This could catch a lot of investors off guard, especially those who have been focusing solely on gold or other assets. Adrian Day has pointed out that we're in a sweet spot where silver is positioned to benefit both from economic uncertainty and a shift in Fed policy. And the rally could start sooner than most expect.
And you're making, you've got the inside track on what's going to happen ahead. But I look on it more as looking at what's good value and what's overvalued, what's undervalued, And, if you like, that becomes timing, but not from sort of predicting anything, just looking at valuations. So right now, for example, in my managed accounts, the accounts we've got in the last year or two that are just gold accounts, they're fully invested. And the reason they're fully invested is because I'm finding lots of good value in that sector. The conservative global accounts that come to me are still 50% cash. And it's not because I've made a prediction, oh, I think the stock market's going to fall. It's because I'm not finding sufficient number of good quality companies that are undervalued. So, if that's your prism, then it sort of takes care of itself. You either hold a lot of cash, or you're fully invested, or you're invested in this sector, or you're invested in that sector because of valuation.
Now, let's take a closer look at one of the most overlooked aspects of silver investing, seasonality. Just like many other commodities, silver follows seasonal patterns that can give savvy investors an edge when timing their entries and exits. By analyzing over 50 years of data, we can see clear trends in how silver behaves at different times of the year. Typically, silver performs strongly from January through March, but there's another key period when silver tends to shine, the latter half of the year, particularly between July and December. Adrian Day and other experts point out that we're entering one of those sweet spots right now. Historically, September and October have been crucial months for silver rallies, and the data from 2020 to 2024 shows an even stronger pattern of gains during this period. What's fascinating is that these trends align with the economic conditions we're seeing today. The combination of a possible Federal Reserve rate cut and silver's seasonal strength sets the stage for what could be a historic move upward. But here's where it gets really interesting. The last few years have shown a shift in silver's strongest months, with October and December emerging as the best performing. This shift may be due to recent global economic disruptions, like the pandemic, which have altered silver's usual cycles. What this means for investors today is that the window for silver's rally might extend well into the end of the year, providing ample opportunity to take advantage of this potential surge. Adrian Day believes this could be one of the best times in decades to hold silver, and if these seasonal patterns hold true, we could see a significant upside in the coming months.
I'm not sure I would call it, a shift is one way of putting it, but I just think these things move in cycles. And so, you can look back from 1966 when the market peaked. It didn't exceed that peak till 1982. Now, this is not pre-war history or anything, because we could talk about the 1929 crash. But anytime you mention the 1929 crash, people roll their eyes and say, well, that was then, this is now. But 1966, that's when the Beatles came out. So it's relatively recent. 1966 to 1982, before the stock market exceeded that peak. That's a long period of flatness. And typically, and of course, that period, just like 1929, was preceded by a long period of, dramatic growth in stocks and dramatic overvaluation. And when your starting point is a point of overvaluation, right, like 1966, and I believe like 2024, when your starting point is then, your next several years are going to be much, much lower returns for that market to get back to a sort of long-term median of growth. And again, it's cyclical. We've seen periods, in the past 50 years when foreign markets have outperformed the US market. In the 50 years that I've been watching foreign markets, this last 10 years is actually the longest period I can think of when the US has been the leader, and so dramatically the leader, for so long. Yes, every quarter, every year, there's one market somewhere that's outperformed the US. But basically, the US has been the strongest stock market in the world among all the major markets for a decade now. And that is an unusual period. Going back, there's been periods when Japan has been the leader, when Europe has been the leader. And the US market may have been a meaningful underperformer. So I think it's all cyclical. And we're just going to go back to that period of foreign markets outperforming the US.
Another factor that often gets overlooked when discussing silver's potential is the role of mining stocks. Adrian Day has emphasized how critical it is to not only watch the price of silver itself, but also the companies that mine it. Why? Because when silver prices rise, mining stocks tend to outperform the metal itself, offering even greater returns for investors. In fact, Day has been right on the money with mining stocks before. Back in 2015, when he identified the bottom in silver, he also pointed out Newmont Mining, one of the largest mining companies, as a strong buy at just $1.15 per share. By 2022, that same stock had skyrocketed to over $1.80, delivering massive gains. So why is this important now? Well, Day believes we're in a similar position with silver mining stocks today. These companies are poised to benefit disproportionately from any rise in silver prices. Mining stocks often act as a leverage play on the metal itself, meaning they can amplify the gains silver makes. And here's where it gets exciting. According to Day's analysis, several key mining stocks are currently undervalued, setting the stage for potentially huge returns as silver begins its rally. Adrian Day has always stressed the importance of value investing, and right now, he sees plenty of value in silver miners. As silver moves higher, these stocks could follow suit, and in some cases, outperform silver by a wide margin. If history is any guide, this could be an incredible opportunity for investors looking to capture gains not just from silver itself, but from the companies that bring it out of the ground. For those who missed out on the early moves in gold, silver mining stocks might just be the next big play.
What's driving it is just the fact that the leaders in the US, which have been the leaders in the world, are just overvalued and cannot sustain the sort of stock price growth that they've had in the last few years. However great a company Nvidia might be, however short in supply whatever demand for their chips there is, the stock simply cannot continue to grow at those kind of rates. And you've got a situation where one stock, Nvidia, is responsible for 50% of the stock market's growth this year. You've got a situation where 10 stocks represent 75% of the S&P. And then when you look internationally, you find that, this Magnificent Seven represents almost 20% of the world index, and things like that just are unsustainable. Nvidia is bigger than the German stock market, bigger than the UK stock market. When you start to look at things in comparison one with the other, then I think you start to realize just how out of whack some of the valuation metrics are. So I think when people a change in the economy, such as interest rates coming down, it makes people look at fundamentals a little more. Because as I say, typically when rates come down, stocks like Amazon's a great company, but these long duration stocks where earnings, and particularly the unicorn stocks with no earnings now, they do tend to fall faster. So people are starting to look for, well, what's underperformed for the last few years? And in the US, I mentioned what's undervalued, and in foreign markets have undervalued, but particularly the smaller markets, not necessarily emerging markets, but the smaller markets like Hong Kong, Singapore, Brazil, some of these markets, even though Brazil's done reasonably well, they've lagged, particularly the US stock market and many of the major developed markets.
So where does all of this lead? According to Adrian Day, silver is setting up for a historic rally, one that could take prices to levels we haven't seen in over a decade. Based on his analysis, if silver can break through the critical $1.32 resistance, We could see a fast and powerful move toward $36.50 and possibly even $40 in the near term. But that's not where the story ends. Once silver gains momentum, it has the potential to go even higher, especially if the macroeconomic conditions continue to favor precious metals. Adrian Day's track record of predicting market tops and bottoms is impressive, and he believes that silver's time has finally come. With technical factors, seasonal trends, and economic catalysts like the Fed's potential rate cuts all aligning, this could be the perfect storm that launches silver into its next big bull market. And let's not forget the added boost from silver mining stocks, which could magnify gains for those who know where to look. The key takeaway: this isn't just another blip in the metals market. Silver's rally could be fast, powerful, and far-reaching. Investors who position themselves now may be able to capitalize on one of the most significant moves in the precious metals market in years. But timing is everything. This window of opportunity won't stay open forever. If Adrian Day is right, we're standing at the edge of a major shift, and those who act quickly could be in for exceptional returns. Now is the time to stay informed, stay ready, and as always, make sure you're positioned to take advantage of the next big move.
These insurance companies write off, not down, but write off their loans on certain buildings where the US banks are still valuing those same loans as part of the same syndicate at cost. So someone is wrong. Maybe the Japanese are being too conservative, but also the US banks and the US insurance companies, because the same with the insurance companies, I think are being too optimistic would be the nice way of putting it. So I think that's definitely a risk. The other risk, of course, with the economy, and everybody knows this, but I think it's worth emphasizing, as the economy starts moving into a recession, let's not forget that the lower 50% of a population in terms of net worth and in terms of income are already really struggling. You know, when the dollar store has sales plunging, that's a really bad sign. Now, you look at Walmart, for example, I think it's important we differentiate. You look at Walmart, and Walmart is doing well, but the CEO on several of the quarterly calls in the last year has said they're noticing an influx of higher income consumers coming into their stores. So, you know, the person that normally shops at Neiman Marcus or Nordstrom might go to Walmart to buy, or Target to buy stuff for their kids. They're not going to go to the dollar store. And so things like Walmart are doing well because of higher income people coming into their stores. Things like McDonald's and the dollar store, which are really focused on lower income consumers, are doing poorly. And we mustn't forget that so 50% of a population already thinks we're in a recession. And when the economy in aggregate moves into a recession, then half of the population